So a new regulation may soon be introduced to guide industrial activities against carbon emissions in Nigeria. The country's Minister of Environment, Amina Mohammed, said this at the Stock Exchange on Tuesday after a meeting with the chief executives of some of the listed companies, in particular those in the industrial manufacturing sector. The minister spoke in company of the chief executive of the exchange, Oscar Onyema. Both of them explained that floating a green bond is one of the strategies currently being considered for the diversification of Nigeria's energy mix. Let's go on to the central bank releasing that new report today on the financial sector stability, showing that the growth in the U.S., the stimulus program in the Eurozone, and the faltering Chinese growth are impacting the domestic economy. The report states also include what the emerging risks are for the local banking sector, stress test scenario on credit default risk, as well as capital adequacy amongst commercial banks. The report states that despite the emerging risks, Nigerian banks and the financial system are strong and resilient. Let's keep it with the global professional services company Ernst & Young, now talking about placing Nigeria, a new report placing Nigeria at the 15th position among 20 countries in its 26 Africa Attractiveness Index. This is Nigeria's lowest ranking in a number of years, as Ethiopia was placed at the top spot among countries with alluring markets and growth potentials. Ernst & Young estimates that midterm outlook for many African countries, including Nigeria and Angola, two main oil producers, remain uncertain due to the slump in crude prices. The advisory firm believes that Kenya and Tanzania are among the 17 sub-Saharan countries which should record a growth equal to or exceeding 5% in 2016. Two-thirds of sub-Saharan African economies are also expected to have growth rates that are above the global average this year. Meantime, the Islamic Development Bank has been helping to improve lives in the dozen of Muslim countries for more than 4 decades without a lot of fanfare. This week, the bank is holding its 41st annual meetings in Indonesia. That's the world's largest Muslim population country, where the IDB will discuss developmental challenges and lay out its path for the future. For several member countries in Asia, that path is likely to include coming on board with the China's Belt Road Initiative.
The 56 members of the Islamic Development Bank include some of the world's poorest countries, as well as some of the richest. The Saudi Arabia-based agency lends tens of billions of dollars, undertakes projects to improve education, agriculture and infrastructure, and aims to spur innovation and trade to help raise living standards in developing Muslim countries. The annual meeting in Jakarta is a chance for delegates and governors to discuss the best ways in which to boost economic development and ensure it is both evenly spread and sustainable. One topic that comes up time and time again is the need for more investment in infrastructure. And that's where the IDB's member countries stand to benefit from China's Belt and Road Initiative. The plan to improve sea, road and rail links from China across Eurasia takes in several IDB member states, including Malaysia, Bangladesh, Pakistan and the Central Asian republics.
Initial signs are that our member countries are quite excited and will be partner in this.
One of the IDB's key goals is to boost trade between Muslim countries, and it believes this to be an area the Silk Road Initiative will help strengthen.
This particular initiative obviously helps connecting member countries, especially Central Asia and other countries that are host for major reserves of energy, raw material, food. So in terms of food security, in terms of enhancement of local economies, and energy sustainability, I think that will be very key.
Others at the IDB meeting also share their view and believe the initiative has arrived at just the right time.
Projects will be implemented if the countries want them, and connectivity is such an important thing, and many of these countries along the route are also landlocked. So I think this is very timely, this project.
The hope for all concerned is that the discussions at the IDB meeting and initiatives like the Belt and Road can be converted into tangible actions that will help improve people's lives.
Okay, let's cross over to Abuja now to hear more from the head of macroprudential at the Central Bank of Nigeria as far as the latest financial stability report for 2016 is concerned. Let's get Dr. Mahmood Hassan on the program. Good afternoon. Thanks for joining us. We appreciate your time.
Good afternoon. Thank you.
Thank you very much. This conversation started early today, but let me remind you very quickly a statement, a very short one from the 2015 Stability Report by the Central Bank Governor, and he says that the challenge arising from the development around the world is for Nigeria to strike a delicate balance between conventional and unconventional measures in the choice of policy tools and strategies for responding to the challenges of economic challenges Nigeria face. Do you think this situation, this position is still the same?
Indeed, it's still the same. The challenges are building. The vulnerabilities, we're seeing them in some sectors of our economy. And indeed, conventional monetary policy tools may not encompassingly address some of these issues. So domestically, we also need to use some unconventional monetary policy tool, which is a global standard anyway. The European nations are doing that. We are seeing some of it in Japan, we are seeing some of it in China, and other emerging economies. And this will include issues of how to stimulate the domestic economy to cushion this exogenous inflows, kind of.
How much of what is in the report and what the central bank think could be achieved will be based on collaborative endeavors between the fiscal side and the monetary side?
Yeah, indeed, almost everything in the report has to be a collaboration between the fiscal and the monetary authority. And we're seeing this collaboration, particularly with this dispensation, where fiscal policies are very, there's a full disclosure of direction of government policies, and central bank is keen into those government initiatives. Indeed, monetary policy is supposed to kind of cushion the impact of fiscal policy on the monetary sector aggregates. So if the collaboration is not, there's no smooth harmony between the two sectors, then you see serious, macroeconomic distortions in the economy. So as we are seeing fiscal crunch and tightening and build-up of fiscal deficit, central bank is also looking at issues relating to excess liquidity, credit squeeze in the system, and other macroeconomic aggregates in the economy. So the collaboration is inevitable.
Yes, in a conversation you had with here on the channel earlier today, a few hours ago, 10 to 11 this morning, you talked about the fact that, yes, the system, this report concludes that the system is strong and resilient. But if you look at the risk side, how much worry should we have, and who should get worried a lot more, the monetary side or the fiscal side?
Since the financial stability report, the monetary side should take much of the bulk. Indeed, the risks are coming in troves. You find more of credit concentration risk than actual credit default risk. You have exposures in the forex sector, and your analysis in the money, you also refer to some of those issues. The exposure we have even in the forex sector, I'm talking of the banks now, you find that looking at the net foreign asset exposures of the bank, they are taking long position. So invariably we can cushion that, or the banking sector can cushion that. But when you look at the trading risks, the incomes that come from foreign assets, and you find that about 30% of bank exposures in terms of loans now are in foreign assets. Devaluation or depreciation or appreciation of US currency will have significant impact for the development in the banking industry. So the concern is for the central bank, more or less, and the financial sector, other players or regulators in the financial sector, including the capital market and the pension fund and the insurance sectors. So it's more of a monetary aggregate management issue than the fiscal issue. They're just kind of injections or revenue squeeze and stuff like that. And you also see credit default risks on the part of the states that are also exposed to, refinancing of some of their shortfalls.
How do you think the international investors, this is a final question to you, how do you think the international community or the investors should see this latest report? How should they approach the relationship with Nigeria on all fronts, whether from direct or portfolio financial assets investment?
Yeah, I think the most important thing is for us to know where are the weakest links. And if we're able to show evidences that we know where our faults are, and we are making efforts to address them, that is a confidence building thing for the international investors. However, the international investors also have their own independent assessments they do. Everybody has his own, capital objectives. They have their intentions of, coming to the Nigerian economy, and they will make their own diagnosis from that perspective. However, it is clear to everybody from the numbers we see, which are full disclosure in the Financial Stability Report, that yes, there are deteriorations in some certain legs. However, what are the provisions that are made to cushion or mitigate against the occurrence of these fragilities in the system? And if you find that, yes, these things are in place, because even banks are also, encouraged to have their own crisis and resolution mechanisms in place. The central bank is also having that. There are early warning systems that have been encouraged to be, applied in the activities of the banks. So you look at all these points, all these indicators, and all these measures to these mitigants, and you'll be able to make a balanced assessment that, okay, these things are quite clear to us, and then the management of the bank or the economy per se are looking into these issues.
Okay, we've got to let you go at this point. Thank you very much, Dr. Mahmoud Hassan, for spending some time here with us on the program. We appreciate that. From the Central Bank of Nigeria, head of macroprudentials. Let's check through at the debt market for today. 111 billion naira is what the financial regulators selling in treasury bills to the marketplace just a few days after the latest inflation reading shows 13.7, a record high. Now let's get to Ayodeji Oyeniyi, who is a fixed income trader at Rand Merchant Bank here in Nigeria. Thank you, Ayodeji. Good afternoon.
Yeah, thank you for having me.
Thank you very much. It looks like a very busy day for all of you. 111 billion naira from the central bank in treasury.
Very busy.
Very busy. Bring us up to speed.
Okay, yeah, like you mentioned earlier, following the inflation number, which came out at 13.7, we're seeing something bearish interest across the curve. So, and like there's also the T-bill auction for today, and on the back of that, market is expecting to be higher by an average of 135 basis points compared to the previous auction. So we've seen sell-off earlier in the day and also late into the close. We've seen a move, particularly on the 1 year, which was around 11% discount yesterday, trading up to like 12.4 and 12.2 today. So for the auction expectation, we're looking at discount rates of 12.5 for the 1 year, which is about 14.6% in yield terms.
130 thereabout, triple digit jump in basis points jump in yield is quite significant. But look at where we finished off in terms of liquidity yesterday, Ayodeji. 103, 105 billion in market liquidity. What are the expectations with this massive mop-up by the regulator?
Okay, we do not see any mop-up from now, given the level of liquidity. But towards the end of this week or probably early next week, we expect a fast disbursement. So at that point, you might see mop-up of liquidity. But that would also be at a higher rate, even where secondary market is at the moment. So if there's going to be any mop-up, we'll be looking at discount rates of 11.5 thereabouts.
Very interesting. What's your short to medium outlook as far as the market is concerned? Do you think we're still in this bearish sentiment mode? Do you think this is taking us to the end of the month, or perhaps until after the MPC?
I expect it heading into the MPC. The bearish view might continue heading into the MPC, but if we do not get any significant hike at the MPC, we might see that reverse quickly. So, for instance, if we get anything short of 200 basis point hike in NPR, we might see markets retreat because market is pricing just about that in the move that we've seen in the past weeks.
Okay, we have a lot. We're counting down to May 23rd, 24th monetary policy meeting. Thank you very much, Ayodeji. We need from Rand Merchant Bank, fixed income trader. Do enjoy your afternoon and the rest of the day. Okay, you can see the ticker tape there where you find the FMDQ OTC ticker tape there. You can always track that anytime here on Channels Television, Nigeria's news leader. That's all for today. Do have a great time, and I'll see you again soon.